Hi class, and welcome to this video, which is going to cover chapter 3 content of the Macmillan textbook, which is all about the accounting system, but probably more importantly, business documents. So we're going to focus on really business documents and how we use them in the accounting system and how we use business documents to interpret financial transactions. Before we start, and I will ask you to pause the video occasionally, I want you to do a quick do now and try and brainstorm all the types of documents a business might use. You might use your year 11 accounting knowledge or all that knowledge you have from part-time work. Have a think, what are all the documents that a business might use? I suspect we'll go through a lot of them in this video. What are the learning intentions of this video? Really two. I hope by the end of this video that we can tick off that you are able to identify and describe various documents for both cash and credit transactions. Because if you can identify the document and describe the transactions within them, then you can start to record and do accounting. I also hope that by the end of this video that you understand how the accounting system works, and importantly, how business documents work within this system. So we're going to do a number of things, and by the end of this work of this video and your textbook questions, you should be able to identify various business documents and describe what the role of each. You should be able to distinguish between documents for cash and credit transactions. And you should be able to use all this information to describe the documentation process in relation to GST. And then we'll really quickly outline the process of the accounting system. And you might want to have a think about what are the advantages and disadvantages of using a computerized accounting system, which happens in the real world. But what is an accounting system? What are the stages of the accounting system that we're becoming an expert of? The accounting system really has 3 stages. The first one is the collection of raw data. Then we record data. And lastly, we report on the results. We do reporting of results. And after that, we might add some more things. After that, we do lots and lots of advice to improve our businesses. When we're thinking about collection of raw data, this is where the business documents come in. Raw data is recorded on business documents, or another term is source documents. So I want you to think of these documents as being the record of the raw financial data of the business transaction. This is where we get the information on. And common documents include receipts, checks, invoices, electric fund transfers, receipts, order forms, and delivery documents. And our goal is to understand what all of these mean. After recording, after collection of raw data, we then record this. And this in year 12 happens in general journals and general ledgers. And this is going to be the new part of accounting from year 11. So of course there is more to come of that, largely coming in the next couple of weeks. From that, we then report, and you are experts on becoming an expert at reporting this information in the 3 reports: the income statement, the balance sheet, and the cash flow statement. So that's where we are up to, really focusing on the collection of raw data and these business documents. So now I want you to think about this question, and again, a good time to pause. Why is it important to collect business documents? I've covered it a little bit. Why is it so important to collect these documents? One of the reasons is the business documents contain all the information for our GST, which we know is incredibly important. Business documents play a key role in the relation to goods and services. We know that the goods and services tax is a 10% tax on the purchase and sale of all goods and services, and it is 10%. And we as businesses don't get to keep that money. It goes to the government. So we are essentially a tax collector. Business documents is where the GST amounts are tracked and calculated. And we know we need to track and calculate GST because we pay to the government what we've received in GST minus what we have paid. So business owners need to be able to verify this amount. This comes from our business documents. And we know that if a question says plus GST, we are going to times the selling price by 10%. So if it says $400 plus GST, our GST equals $400 times 10%, which equals 40. When a question says including GST, we divide it by 11. So let's do a double check. If it says 440 including GST, that means we're going to go 440 divide by 11. It means our GST is 40. This is how we go through it. So we're going to have to be good at identifying from our document, does it including GST? Does it say plus GST? What are we going to use how are we going to identify all this information? This is important, as I said, because the businesses that collect GST on behalf of the ATO and the GST passes through the business and must be recorded and tracked. Any GST that we collect increases what is owed to the government. Any GST that is paid decreases. So as we go through this year, we're going to start to becoming confident with this account called GST clearing, which is reported in our balance sheet, and it will either be an asset or a liability depending on whether we owe money to the government or whether the government owes us money. If we owe money, it is a liability, and that's what it normally is. And we are going to call it a GST liability in our balance sheet. This means that it will be a current liability, and at some stage we will do a GST settlement where we pay that liability off to the government. Often, or not often, rarely, our GST will be an asset because we have paid more GST than what we've received, and this will be a GST refund in our balance sheet. And at some stage along the line, the government will give us cash. So quite complicated, but what we're focusing on now is how do we get that information? We get this information from documents. And you might have even heard this term, tax invoice. Not to be confused with an invoice because it's a credit transaction. It's a tax invoice like this because all business documents, if they relate to GST, will also be called a tax invoice because they include GST in their information. You can see here, this is a tax invoice because GST is included. It is our evidence of whether we've paid or collected tax. Any of these tax invoices have some information that must be in there. And you'll often be provided this information in a form of a source document like I've just shown. Now, the key bit that I want you to understand as a Year 12 accountant is that your task is going to be being a detective because you need to decipher what information is being provided. So I want you to pause the video and try and work out what do you think this transaction relates to. Can you have a guess of what this transaction is all about? There is a lot of information, so pause it and try and work it out. Hopefully, you got something in your mind of what this transaction is, but there is a lot of information. All tax invoices must include all of this information. The name of a business, the business's ABN or business number, the words tax invoice, a document number so we can track it, the date, a description, the purchaser's name, and the GST amount. Now, the key bit here is I want you to understand is that the business's name at the top of the document, Santos Sports Stores, is the business that has written this invoice. What does that mean? They're the ones that have done the selling. So if we start to decipher this, Santos Sports Stores have made a sale to Brunswick Primary School, and they have sold $770 worth of goods, including GST, being $700 of goods plus $70 of GST. And that was for 10 footballs and 20 soccer balls. So if I'm Santos Sports Store, I now have all the information to start to record a business transaction, a sale of $770 plus GST to the local primary school. And I can start to report and record this in my accounting system. So what are the source documents you're going to see? We're going to now focus on source documents for cash transactions. Now, if we have a cash receipt, that means our cash is going up. So our asset cash is going to go up. And we know this if we see a document called a cash receipt. There are two kinds of cash receipts: handwritten ones that might look something like this. In this case, we know the customer that made the document is at the top, MB Costuming Supplies. They have made a sale of $400 to L Palmer. Sorry, not a sale. They have received it because of payment on account. That means L Palmer has paid them back some money they owed. They could also be FPOS receipts, because we're moving into the world where a lot of our cash receipts come from people transferring money from their bank account or using FPOS. This means there was a sale of $45 for MB Costuming Supplies. But if you see the word receipt in your source documents, that means your business has received cash, or the business that is at the top of the document has received cash. So how do you know that this is a cash receipt? Describe the transactions. We've done a little bit of this. Maybe pause the video and can you work this out yourself? The next type of transaction we're talking about is still a cash transaction, but cash payments. Now, traditionally, businesses used to make cash payments with something called a check. This is where a business owner would have a checkbook. They would write the information, give the person that they were meant to pay cash to the check, and they would go to the bank, and the bank would organize for the money to go into their bank account from the person who was paying the cash. Sounds pretty prehistoric because it is, but it's still in our course, and our source document is the check butt, which looks something like this, which was the other part of the check, which remained in the checkbook, which was always the evidence. Now, these days, most cash payments are done by electronic transfers because this is a much more efficient way to do this. But in your accounting year 12 course, you might see checks, and you're often going to be seeing them as in a transaction listed as check like this, and then the number. So for example, this number is 245, and I'll show you where that is at the moment, right down there. Or you might see bank statements. But we can start to analyze this transaction, and I'll go back. We can start to analyze this transaction that we know we as a business have made a payment in cash to our insurance company for $1,320 right here, because we paid for yearly insurance, $1,200 plus $120 of GST. This would mean our assets go down, and we have a new expense, and this is how we use our documents to analyze information. We also have credit transactions. Credit transactions are when we either purchase goods and services, often inventory, and we promise to pay our suppliers back at a later date, or we might make a sale and our customers agree to pay us back within a certain time. The document is the same, but we're going to this time focus on our credit purchases. I say that the same because anytime there's a credit transaction, this means that we have a document called an invoice. Not to be confused by the tax invoice, this one is a specific invoice. Tax invoice is also a cash receipt if it tells us GST information. So an invoice is going to tell us that a credit transaction has taken place. And it's going to outline the total cost of the goods, when it's going to be received, and if we can identify that the credit transaction is a purchase, so I'm purchasing on credit, we call this source document a purchase invoice. And it might look something like this. So how why would a business buy on credit? Firstly, why would a business buy on credit? Often it's because they don't have the cash to do this. It allows them to save some liquidity because they have more cash to pay on other things, and it allows them to manage their business. So now I want you to know is, how do you know that this is a credit transaction? How do you know that this is a credit purchase? And can you describe the transaction? Now, the first thing that we need to know is, how do we know that this is a credit transaction? And we don't want to get bogged down by this term tax invoice. Remember, that could be a receipt. But there are other clues here that tell us it's a credit transaction. The first one is this one, and really the major one, credit terms. That means there is a credit transaction because this means you don't have to pay cash for 30 days. There's no discount for this one. How do I know whether it's a purchase or a sale? Well, you know the business that wrote the document, their name is going to be at the top. So the Central Tailing Supplies has done the sale. They have sold it to MB Costuming Supplies. And you remember that is the business we've been looking at. So if something has been sold to me on credit, that means I, the business MB Costuming, has a credit purchase. What have I purchased? 12 dressmaking scissors for $480 plus GST, and 10 buttons that cost me, 100 buttons that cost me 10 cents each, so $10. There's a total of $490 plus $49 of GST, totaling $539. So if I bring this all together, my business MB Costuming Supplies has purchased on credit $490 of inventory plus GST of $49. And I can start to put this into my accounting system. Credit sales are going to look exactly the same in terms of the document, but if my business is at the top of the invoice, this means that I know that I have made the sale. I know it's an invoice, a credit transaction, because there's credit terms, and I have sold something to L. Barnes. What have I sold? Some fabric, 2 of them, at a cost of $10 each, so $20 plus $2 GST. And I've sold 6 buckles that I sold for $2.50 each, so $15 plus GST. I have made a credit sale of $35 plus $3.50 GST, and I expect this customer L. Barnes to pay it back in 30 days. I can start to build up my transaction. And this allows us to use our detective skills to describe transactions. And they're really the 4 major documents you're going to see in terms of credit, sales and purchases of goods. But there are many other transactions. So let's go through them in a second. But before that, can you pause the video and identify what this transaction is and explain it? I'll let you do that. I won't go through the answers. If you're in my class, I'm sure we'll go through this in class. So what are the other source documents you might see? The major one you're going to see in our course are memos. Memos are a note that is used to record any internal transaction, and you'll see a lot of them. They're really informal. It's just us writing something down because we've had to do a transaction. It might be the owner contributor withdrawing assets. Memos might be used for this, or many other things, particularly balance day adjustments and things like this, which are much more complicated accounting that we'll go through throughout the year. For example, here is a memo. It looks quite simple. My business MB Costume Supplies has withdrawn 1 tailoring mini torso of $210. I have done drawings of $210 of inventory. Now that's an important thing due to the entity accounting assumption. I must record this. So I'm going to have to record, for example, inventory going down, being an asset, and my owner's equity going down because of drawings. And that allows me to do this. I have some evidence for this. We might have statements of accounts, which are documents issued to customers summarizing the transactions, credit customers in particular. So letting them know how much a customer owes us. So for example, this is talking about these guys, us. How much do we owe Central Tailoring Supplies? What are other source documents? We might have order forms. This is not a transaction nor a source document, so it's something that we do not have to record. Or quotations, a quote to do something. Again, important documents, but something we don't have to record because nothing has actually happened yet. There has not been a financial transaction. Other source documents you might see are delivery dockets, not recorded in the accounting system. Shipping confirmation, not recorded in the accounting system. And this then comes to our final part, why do we care? If we look at an overview of our accounting system, which is going to get pretty complicated, as you can see, and you might be not totally sure about what everything is in this thing. Why have I shown this? Because all of these steps, which ends up in reports, evaluation, so advice, planning for the future, all of that starts with source documents. The original records guide our entire process. If we don't have a good record to look to store and record documents, we're going to miss things. We're going to have garbage accounting system, garbage data, which leads to garbage reports, garbage evaluation, and garbage planning. That is a bad business. So it's important that we as a business have a great process for source documents. Sometimes that system we have is a computerized system and all those source documents are done via computers. And this allows us to potentially have some advantages, less error, less paper, and hopefully that means our output of reports is better. A very minor part of our course, highly unlikely you'll see something in the exam, but it is important to think about what the advantages and disadvantages of a computerized system of this accounting process might be. And if you're really interested in that, for our textbook, that is on pages 56 and 57. Now, let's do some quick revision. What source documents would you see for different transactions? If we charged a customer for a credit sale, you know that it's going to be a sales invoice. So sales invoices, credit sales. If I paid cash for spare parts, it's a cash payment, and it could be a check but or an EFT, so an electronic fund transfer. I've done it via my bank. And so on and so forth. And I recommend that you pause the video to work through this, or potentially just go back and try and work them out. We will start to become experts at working out what transaction leads to which source document, or maybe even better, if I see a certain source document, I can start to identify what transaction it is. For now, I hope that we have been able to tick off all of our learning intentions and success criteria in a relatively long video. And now's the time to practice this, being that detective to identify all this information so we can start to record, report, and analyze business transactions.